Hello, this is Bob. Still in this lecture, we will take a look at a problem that will be similar to the homework and or assignment. The problem will look like this. We're going to work it in an Excel sheet that will look like this. Even if we're going to put the numbers in to connect, I recommend putting them into Excel first for multiple reasons. It will help with the calculations. It will help to see relationships between numbers. It will help if you need to redo the problem in Connect, which you can do most of the time. And it will also just help with formatting within Excel, which is useful in and out of the accounting department. So we're going to put the journal entries in over here. We're going to post that to this column of the trial balance. This is our beginning numbers. We're going to post the adjustments here. Instead of posting them to the GL, we're just going to post them into this kind of a shorthand GL just to see the activity and see the effect of the journal entries on our trial balance. We have a very short trial balance. We only have cash and merchandise inventory at this time, adding up to 30,000, which equals our capital account of 30,000. Assets equal liabilities plus owner's equity of the 30,000. I'm going to hide some of these cells over here so that we're only working with one set of journal entries. So I'm going to put my cursor on column F and drag over to column J, let go, right click on the selected area and hide that area. Then we're going to take the top, I'm going to left click on the top and snap that to this side, and do that with my worksheet over here, snap that over here, and then move to the first problem. So we have on July 1st purchased merchandise from Bowden Company for 6.5 under credit terms 2/15 and 30 FOB shipping point, invoice date July 1st. Okay, first I'm going to ask the normal questions. Is cash affected? And in this case we're going to say no, because we purchased it on account. We purchased it on these terms, these shipping terms. Therefore we didn't pay cash for the merchandise. What did we pay for it instead? An IOU. In that case, that's a payable. Now, payable is a liability. We haven't had as much experience with liabilities. We have a lot of experience with assets because we work with cash a lot. So let's think about the other side, because we may not know what we're going to debit or credit in terms of the payable account. What did we receive? Merchandise. Merchandise has a debit balance, just like cash, and we know we got more of it. Therefore, we know that it has to go up. How do we make something go up? We do the same thing to it. So we're going to increase the merchandise. We're going to put that on top. And the merchandise is 6.5. That means we're going to credit something, and that credit we just said was to accounts payable. So now we know we're going to credit accounts payable, and let's see if that makes sense. Accounts payable has a credit balance, and we need the bad thing to go up by doing the same thing to it, which in this case would be another credit. So we're going to increase the payable by crediting the payable. So let's post this and see what happens here. So I'm going to go to merchandise inventory in cell M7, say equals, and then point to this merchandise. That's a debit. This is a debit. It's going to make this number go up in the debit direction to 11.5. We're out of bounds by 6.5. We're going to put our cursor in M8 equals, point to the credit. That's going to make the credit go up in the credit direction. Not a negative number for us right now. It's a credit. It's a negative number for Excel, but for us it's going up in the credit direction, and it'll put us back in balance. No effect on net income down here because there's no effect on any of the income statement accounts. Now, the new thing that we want to take a look at is that this merchandise inventory was purchased from Bowden. So when we look at our accounts payable account here, we can see that by date on the general ledger. We can see what happened by date, but what we really want to see also is by vendor. So we really need to back this thing up with another worksheet, just not by date, but it's by vendor. So that's going to be this account down here. We can say accounts receivable subsidiary ledger by vendor, and I'm going to put this in the credit for Bowden here, and I'm just going to repost just this part of the journal entry. I'm going to enter that 6.5 credit, and what that does is it backs up the accounts payable number. So we're looking at accounts payable here of 6.5. Well, who do we owe that money to? Well, it backs up here. We owe it to Bowden. The two accounts payable accounts here add up to the same amount on the trial balance here. Also, we have these new terms. We have 2/15 and 30 FOB shipping point. So that means that there's a 2% discount if we pay it within 15 days. And if we do not, we have to pay it within 30 days, or else collection action might be taken against us. FOB shipping point means that the transaction of the inventory is now ours as of the shipping point date, as opposed to the date that we received it. So if we got something from China, let's say, we now are taking responsibility at the point of shipment on the boat, if it got on the boat there, as opposed to us receiving it when it gets to our dock. Therefore, we're liable for it if pirates take it, on the way over here. So that is going to be that. And notice we don't have to worry about that now, but we do have to worry about this discount when if we pay it within the discount time period, then that's when that's going to take effect. All right, so let's look at 7.2. Sold merchandise to Creek Company for $1,000 under credit terms 2/10/60 FOB shipping point invoice dated July 2nd. So now we're selling inventory. So the first question is cash affected, and the answer is no, we sold it on credit this time. So in this case, people don't owe us cash, they owe us basically an IOU. They gave us something, they gave us a commitment, they gave us an IOU. That's accounts receivable. Accounts receivable is an asset, it's up here with all the other assets, has a debit balance, people owe us more money, therefore we're going to do the same thing to it, which in this case would be another debit. So the receivable in this case is going to go up. It's going to go up by 1,000. That means we're going to credit something 1,000. And why are people giving us money? Because we earned it. And therefore we need to credit revenue or income. And the trial balance is in order. Assets, then liabilities, owner's equity. Income is down here. Income generally has a credit balance. We're going to credit it again by doing the same thing to it, which in this case is another credit. We call income sales in this case because we sell stuff. So when we earn money, when we sell things, that means we earn it at the point of sale, when the transaction takes place, when we give the inventory. Now this is the same type of journal entry that we would have for a service company, but now we sell inventory. So there's a second piece to this that we need to think about, and that is the fact that inventory is now being given up and is being turned into an expense because we are consuming that asset in order to generate revenue in the same time period. So inventory has a debit balance. We need to make it go down. I'm going to do the opposite thing to it in order to do that, which in this case is a credit. So I'm going to skip a line, and then I'm going to skip another line and put it on the bottom to make another journal entry, even though this is part of the same transaction. And so the amount is going to be the merchandise had cost, a credit of 542, and then we're going to debit something for 542 as well, and that debit's going to be an expense. It doesn't have the word expense in it, but it's our main expense down here called cost of goods sold, the cost of the inventory that we are selling. And so I'm going to copy that and put that here, paste it 1, 2, 3, and then let's post that out and see what happens. We're going to go to cell M6 equals and point to the receivable here. So the receivable is going to go up. And then we're going to go to sales down here in M10 equals, I'm going to point to the sales. That's going to make sales go up, put us back in balance. Now we have net income. That's not a loss, that's income. That means income is beating the expenses. Then we're going to go to the cost of goods sold here in cell M13 equals, point to the cost of goods sold. That's going to make net income go down. So we really only earned $458 net of the cost of the merchandise. Then we have to reduce the merchandise. There's something in it. So I'm going to double click on it, go to the end of it and plus, and then point to the merchandise, which will make that debit balance go down. Okay, so then we're going to take a look at the next transaction, which is on 7.3. Paid 110 cash for freight charges on the purchase of July 1st. So is cash affected? Yeah, we paid cash. Therefore, cash is going down. Cash is a debit balance. We're going to do the opposite thing to it in order to make it go down, which in this case is a credit. We'll credit cash for the amount we paid, which is 110. So we're going to make a negative 110. That means we're going to debit something for 110. And you would think it would be like freight expense or something like that. But in this case, we bought the merchandise for it with that freight. That's part of the cost of us getting the merchandise, and therefore it should be included in the cost of the merchandise. So that inventory is going to go up because we're going to do the same thing to it. It's a debit, we're going to debit it, making inventory go up, which makes sense because the freight involved in us purchasing the inventory should be part of the inventory. So then we're going to post that. I'm going to double click over here. I'm going to go to the end of it and plus and point to the 110 and enter. So then we got the 110, we're out of bounds. We're going to go to cash then at the top on M5 and equals and point to the cash here and enter. Alright, so now we are on 7.8. And it says sold merchandise that had a cost of 18422 2002 cash. So is cash affected? Yes, in this case, we sold it for cash. Cash has a debit balance. We sold stuff, received cash. Cash needs to go up. How do I make something go up? We do the same thing to it, which in this case would be another debit. So we're going to debit cash for the amount we sold it for, which is 2005. Therefore, we're going to credit something 2005. What are we going to credit in relation to sales? Income, sales. We sold stuff. Revenue is going to go up. Revenue's down here. It's called sales in this case, sales revenue. And it has a credit balance. Revenue only goes up. It's going to go up by doing the same thing to it, which in this case would be another credit. So revenue is going to go up. Notice this is our favorite journal entry. Cash is going up. Revenue is going up. Income's going up. And cash is going up. Both the debit and credit are good in this case. Now notice that when we sell stuff, though, we also have the second half of the journal entry, meaning we sold inventory. Inventory needs to go down. Inventory has a debit balance. We're going to do the opposite thing to it, which is a credit. I'm going to think about it as a separate journal entry, even though it's happening at the same time. So I'm going to skip a couple lines, put it on the bottom, like so, and then we're going to debit something for that account. So you want to try to keep these two paired in your mind, that there's two separate transactions that are kind of happening at the same time when you're recording a sale of merchandise. And then we're going to say the debit is going to go to the cost of goods sold. So we have assets, liability, owner's equity, income, and expenses. Cost of goods sold is an expense. It's going to go up by doing the same thing to it, which in this case would be a debit. So we're going to debit the cost of goods sold. Then I'm going to post this. I'm going to double click on the cash, and then go to the end of that, plus point to the 25 cash, and cash goes up. Something's in sales. I'm going to double click on sales, go to the end of it, plus, and go to the 25, which will increase sales and increase net income over here. Sales went up and put it back in balance, and net income went up. Now we're going to post the second part. I'm going to double click on cost of goods sold and M13, go to the end of it, plus point to the 1.8. That will make the cost of goods sold go up, make net income go down. So net income goes down. Remember, income is still winning. That's income and not a loss. Then we're going to post the merchandise inventory in M7, double click on it, go to the end of it, plus, and point to the inventory, bringing merchandise inventory down. I also want to point to this transaction up here that happened on 7/2. Notice that we had this 1,000 that we put in here. Same question is, and the accounts receivable is, who owes us the money? So we need to back that up with a subsidiary ledger. So you notice in 7/2, the person who owes us the money is Creek. So we're going to back that up with another subsidiary ledger here and say that Creek owes us the money. And I'm going to say, how much does Creek owe us? Creek owes us this 1,000. So if our boss says who owes us money, we say people owe us money of $1,000. If they want to know who owes us money, we're going to have to go to another ledger, a subsidiary ledger, and say, of that 1,000, who owes it to us? Right now, it's just Creek. Let's take a look at the next transaction on 7/9. Purchase merchandise from Light Company for 2/5 under credit terms 2/5/N60 FOB destination invoice date July 9th. Okay, so once again, is cash affected? In this case, no, because we purchased it on account. Therefore, we purchased it on credit. We often think of that's going to be like accounts payable. But accounts payable has a liability. It might be easier to think about what we received in this case, which was merchandise, in order to know if we debit or credit it. And merchandise has a debit balance, and we know that merchandise is going up, so we're going to do the same thing to it, which in this case would be another debit. So we're going to debit merchandise, and that debit is 425. We're going to credit then something, that something being the payable account. Payable is a liability. We see it has a credit balance, and we know we're going to credit it now. Credit it being the same thing as what it is, making the liability goes up, which makes sense because we owe more money because we're buying something on account. So the bad thing is going up in this case. All right, so there's the journal entry there. We're going to post that on M7. Going to double click, going to go to the end of that and say plus, point to the 2/5 in merchandise and enter. Then I'm going to double click on the cell in M8, go to the end of it and plus, and point to the accounts payable, making that go up. Now once again, now we have 9,000 in accounts payable. The question is, who do we owe? Well, in this case, we owe this to light. The second transaction is posted to light. So I'm going to go over here in light account. Notice we're off by that amount, the 6.5, and say that